Hi, everyone. It's Larry Kotlikoff. I'm here with one of my good buddies, a brilliant economist, Torsten Slok. He's the chief economist for Apollo, which is one of the main investment banking companies in the country, if I've described that correctly. Torsten was one of our early podcast stars in Economics Matters, the podcast. If you go to larrykotlikoff.substack.com, you can sign up as unpaid or paid subscriber. You'll get the same content. But anyway, if you look through the list of podcasts, you can see our discussion of inflation. And back, I guess it was maybe in the summer or so, or late spring, we were talking, Torsten, about inflation potentially being a supply side phenomenon that was going to come down, and it certainly has. So we'll get into that. But before we do, can you just kind of briefly remind the viewers, and certainly the new viewers, about your background? You're a Dane, and you're among the happiest people in the world, because we know from the studies that the Danes are truly the happiest people. And maybe you can explain briefly why that is. but anyway, tell us about where you grew up, how you got, where you went to school, how you got into economics, what you did. You were the head of the chief economist for Deutsche Bank when I met you, and then you were just moving to Apollo. So tell us about your whole career, because people are really interested in careers and how to get where you got.
So thanks so much again for having me, Larry. It's great. I listen to your podcast every week. I think it's fantastic. It's really good conversations about everything that's going on. There's no end of topics that we can deal with in economics here. So the first thing on why the Danish people are the most happy ones, I think, is because it's self-reported. And when it's self-reported whether you're happy, then it becomes easy to say whether you're happy or not. And then the question is, if there's a big welfare state, is that what makes you more happy? Is the relationships? That's for the researchers in happiness to figure out. But I was born in Denmark now many years ago, and I took my PhD at the University of Copenhagen with a professor who you know, Niels Thygesen. And in most European universities, the PhD in economics is only 3 years. And because the coursework is not always great, and in some cases when I did it, there were not that many PhD students, they basically say, go away and go to the US and do coursework for a year. And that's normally year number 2 out of the 3 years. And I spent 1 year in Princeton. I worked with Michael Bordeaux, and Barry Eichengreen was visiting Princeton at the time, and I was research assistant for them. And they both recommended me to be a summer intern at the IMF in Washington, DC. This was in the mid-1990s. So the year after, this was 97, I was a summer intern in the World Economic Studies Division, which is the division at the IMF that writes the World Economic Outlook. And the following year, I was so lucky to get a job offer from the IMF to first become an economist in the division that covers China, Hong Kong, and Mongolia. And then the year after, I came back to the WEO, the World Economic Outlook division. And by the way, they just published the latest World Economic Outlook. That's always very interesting. It's like a tombstone of 150, 200 pages of all the details of the global economic outlook. It's always worth a read. You can find that on the IMF homepage for anyone who's interested. And after that, I spent the 2 years at the OECD in Paris. And after that, one of my managers from the IMF asked if I wanted to come to New York and work for Deutsche. So since 2005 to 2015, I worked with Deutsche Bank and ended up being the chief economist. And in 2020, I changed to Apollo, where I've been now for 2.5 years. And at Apollo, I'm the chief economist. I spend half of my time externally talking to investors in our funds, and I spend the other half of my time internally talking to deal teams about different things that they're looking at, whether the macro backdrop is supportive or not supportive, and how should we think about the macro picture when we think about individual companies. So for a long time, it was mainly inflation, unemployment, which we'll be talking about here. And now I'm also spending more time on corporate finance, despite that I don't have a background as an MBA or in corporate finance, but I'm learning every day from my colleagues. It's an awesome environment, and it's a great discussion always. So trying to combine the micro with the macro of is something a good idea or is something not a good idea, and what are the arguments for why we're doing something. So I've done economics for basically most of my adult life, and that's what I spend most of my wake hours on still here.
That's another reason you're so happy. So
Exactly.
the non-dismal economist, scientist, but tell us just a bit about Apollo, what their main line of business is, because it's known to people on Wall Street, but not everybody's from Wall Street who's listening.
Yep. So as usual on Wall Street, there is the sell side and the buy side. The sell side is the investment banks. They sell securities, they sell services. They basically are providers in the bigger scheme of things of universal banking services that can basically help companies, investors at the highest level, mainly institutions trying to deal with whatever finance problem that they have. The buy side, to which Apollo belongs, is of course those who buy assets. And what really distinguishes Apollo from others is that we mainly buy private assets. So that means that we deal in everything that is not listed on the New York Stock Exchange. So that's of course both private credit, meaning giving loans to companies. That's private equity, meaning buying companies. And it is buying real assets, buying everything from real estate in different forms, infrastructure, and real assets more broadly as an asset class. That again are investments that are done outside of the public markets. So it's really, and Apollo has about 550 billion assets under management. And we are the biggest in private credit in the world with about 400 billion. So it's a lot of investment decisions outside the stock market, outside of the listed exchanges. But that's what makes it so exciting, namely thinking about what should we be investing in and what should we not be investing in.
And the money, the investors, are they lending or are they buying equity? Are you an equity financed or debt financed?
Both. So about of the 550 billion, in very round numbers, about 400 billion is private debt, meaning private credit, meaning the debt, either debt solutions or just simply giving a loan to a company. About 100 billion in round numbers is private equity, and the remaining 50 billion is real assets. So that's why
it's your asset side. What about your liability side? Are you purely equity financed, or are you?
So the way we are financed is by outside money, and very importantly, Apollo also is an insurance company that's called Athene, which is annuities, and which are very long dated annuities, and that's where a lot of the money is coming from. That's being invested both in investment grade credit and of course also in private assets.
So you're selling annuity insurance to raise money that you then invest.
So like any other insurance company, we sell insurance, in this case annuities, and the money that comes in we invest and then try to get the best return.
I see. So in some sense you're a leveraged bank, would you say?
Well, banks have much more leverage in many ways in what they do, but we take $1 from someone who has bought an annuity policy with us, and we then invest that dollar in different assets.
I see. Got it. So anyway, at some point we'll talk some more about Apollo, but let's talk about the general banking crisis. Let me just describe my understanding, but I'm really keen on yours, your take. It seems to me we're kind of like at an inflection point with this old banking system. The history of money and finance, I was lecturing to my undergrads this morning. I said there's no single thing that we call money. There's this transactions technology, exchange technology, financial technology that's been changing through time, and that we have things like ATMs and debit cards and Venmo that we didn't have when I was a kid, for sure, and wiring ability. There's all kinds of things that that weren't there. So I'm thinking that the current banking system, the traditional commercial banking, which consists of something like 4,200 FDIC insured banks, that they're likely to be, that they're reasonably, it's reasonable to call them the dinosaurs of the financial world, that they're potentially going to disappear. The reason being that if you have they've got about 18 trillion in deposits, 8 trillion are uninsured. The numbers might have moved a bit of late, but because there's been a big sucking sound as people have been moving their uninsured deposits. With SVB, they had like 98% or so, 97% of their deposits were uninsured. And when they realized that they are on their asset side, that they were using the accountants with the permission of idiotic accountants, they were marking their assets to maturity. And of course, the Fed and other government agencies permitted this, which means that they weren't really coming, fessing up to the fact that their assets were not worth what they were saying. So when they had to sell some of these long-term treasuries, which would otherwise be safe assets, but they were long-term and interest rates went up, so the market value went down. When they had to sell a small share of those assets, they had to acknowledge that those assets had dropped in value, and then everybody realized, hey, all the other assets are down in value. This bank is broke. Now, I've seen reports that over half of the FDIC 4,200 banks are bankrupt when you mark to market. So if I'm an insured investor, a depositor in one of these banks, I would want to get my money out, because if that bank goes under, and half of them, more than half of them, literally are economically broke, so they should, in some sense, go under, not be able to pay me off if there were a run, then I'm going to lose my money. And there's no guarantee that that the Treasury, the Fed, the FDIC, the Three Musketeers will insure my deposits. Because if they did insure the deposits, if we did have a big, massive bank run, losing all 8 trillion of the uninsured deposits, we've already seen about 600 billion leave. Then we would see the FDIC having to come up with massive amounts of money that they don't have, since they probably are close to no money left after they've dealt with Signature and SVB. Probably have to quickly deal with the First Republic, and then maybe Charles Schwab, that seems to be in trouble. I don't know for sure, but the FDIC would have to go to the Fed. The Fed would have to print money to give them, or that would be the perception that they're printing money to bail out the banking system. Then there's the perception of inflation. Money could turn into a hot potato. We have inflation happening, or the fear of inflation. More people run, including the uninsured deposits. The entire thing can melt down. So we have two bad equilibria here. We have an equilibria where everybody, in any given bank, there can be a run, but then there's this macro equilibria where everybody believes that even if everything's insured, the multiple equilibria here is that nobody trusts the FDIC and the Three Musketeers to really pull this off without high inflation, and therefore there is a run, and then the entire financial system melts down in the process. That's a grim scenario. Tell me if that's crazy.
No, obviously the main issue, as you're also highlighting, is how sticky are deposits? In other words, to what degree will deposits stay even when interest rates are zero on checking accounts? And obviously there are different types of depositors. There are households, there are corporates, and some households may be more interest rate sensitive. Some corporates may be more interest rate sensitive. And as you know, the whole discussion about what is it, so-called deposit beta, in other words, when interest rates move, then what is the propensity to take your money out? At least it looks at the more recent data in the last few weeks, it looks like things have begun to stabilize somewhat in terms of the outflows. But you're right, the discussion at the moment, there are several new academic papers that also look at this, which exactly, as you know better than me, try to focus on, how should we think about the deposit base if people suddenly just can take out their iPhone and can move money around between accounts? Normally we think of a bank run as people lining up outside the banks and taking time to take money out of the ATM machine or from the bank teller. But now you can move vast sums around just by picking up your phone. And that's what we saw with Silicon Valley Bank. In a few hours, they lost $40 billion in the deposit outflows. And we've seen other regional banks in the following week lose about 40 billion of their deposits So the money is being moved around quite substantially, and that is certainly a new issue that regulators and everyone, when they look at depository institutions, needs to think about. And most importantly, the critical statistic here is that 10 years ago, the primary point of access for your bank, for 39% of the population, the answer to what is your primary point of access to your bank was mobile or online. That's gone up over the following 10 years, again, from 39% to now 66% of households use their phone as the main point for accessing their bank account. So the more people use online banking and use mobile banking, we thought really, us as in the academic profession, as you know also too well, of course, that this was only an issue for the digital dollar that may or may not be coming, but this certainly now has become an issue even for ordinary banks. So there's certainly, from a regulatory perspective, there's certainly a lot of things to think about here in terms of what are the risks now that you could have money being pulled out of banks so relatively quickly as we've seen over the last 3-4 weeks.
Yeah, the ability to, I think this is going to be called the great tweet banking crisis or something like that, tweeted banking crisis. I wrote a book in 2010 called Jimmy Stewart is Dead, about the banking crisis we had in 2007, 2008, and how to fix the banking system. And the reason I chose that title, Jimmy Stewart is Dead, because Jimmy Stewart is the actor in It's a Wonderful Life. It's one of the most viewed movies. You've probably seen that. I don't know if, you know, and it starts out with Jimmy Stewart giving this fantastic, there's a bank run in a small bank in this town. He's the local banker, and he gets on top of the stands up on top of the table there and gives a talk to everybody crowded into asking for the money back, and he persuades them to leave the money. But you're saying they're not even going to be gathered together for anybody to even give them a talk, give them a speech, let alone have a Jimmy Stewart give them a speech. So we don't have any Jimmy Stewarts here to save the day. The regulation here, if you think about under Dodd-Frank, they allowed 90% leverage. So that means you could lose 10%, the assets could drop 10% in value and you'd still be okay. But if they dropped 11%, you'd be bankrupt. So we have, out of the 4,200, we have like 2,300 banks for whom their asset value marked to market has dropped below 10% and or whatever their leverage ratio. They might have been even more leveraged, maybe 92 or 3% leveraged. And so those banks, are certainly, if there's not a run and they're forced to meet them, one of the things that the accounting profession seems to have wrong here fundamentally is that they're saying that, well, the value really is here because if they just hold the stuff to maturity, these assets, they'll get paid off dollar for dollar what they were promised. That's true. But in the meantime, they're going to have to pay market rates to keep the money. And then on a cash flow basis, they're going to be making negative profits. So they're going to go broke either immediately or slowly. So if I'm the chief financial officer of any company, or just anybody with any brains who's got wealth of money above 250,000 in any bank around the country that Janet Yellen has not yet declared systemically important enough for me to agree to insure all the deposits, I would want to take my money out this afternoon or this second by tweeting all this podcast, because why take on that escrow? Life is risky enough, right? This is what I'm trying to get at with this institution of banking becoming a dinosaur. It's adding an extra level of risk that we don't need. Now, in your case, in Apollo's case, you have your leverage, but you're leveraged in a very interesting way, which is that you have to pay back these loans on a long-term basis, very slowly through time, right? So it's like, whereas the typical commercial bank here is leveraged on demand. These deposits can be withdrawn on. That's why they're called demand deposits.
And that's why that's a fundamental duration mismatch in the banking model. That banks borrow short, meaning we get some money from depositors in a bank, and the bank then takes that and lends that out long. And there's therefore a degrees of mismatch between what's the liability side and what's the asset side of the balance sheet for the banks. And that's why the vulnerability here is really about what's going to happen, not only really to deposits, but really also to the funding costs. In other words, let's say that we were a bank and we had a customer coming in who would like to buy a car. They would like to borrow $30,000. Well, then we would need to turn around, you and I, and figure out, okay, where can we find $30,000 in our bank to give to this person? Do we take that from our deposits? Do we take that from bank funding markets? Do we take that from Federal Home Loan Bank System? Do we take that from the Fed's overnight reverse repo? What would be the source of the money that had to go to the person who would say, go and buy a car? And therefore, the most stable funding source that banks have had for a long, long time has been deposits. And the question now is that now that there's more discussion about what is the role and how sticky are deposits, and are deposits maybe less sticky than what one would have thought, then that of course raises the risk of, okay, but is there then maybe some regulation coming or required to make deposits more sticky? And if that's happening, and this is why a lot of discussion about what regulation is coming in the pipeline for the regional banks, because that support could be very, very distorting.
What kind of regulation?
So one idea could be to say, just in the most simple example, you can only move a certain amount of money every day. Of course, that's very, very unusual, and that's not going to happen. But that's at least one way of limiting the amount of money that's being moved around. So that's why they will need to think about a way to, if there is a risk of a bank run that can come so quickly, then there's probably some thought process going into what kind of rules can put in place to avoid a similar situation again.
So this is bringing us full circle to Argentina. So when I wrote my book in 2010, I was sitting in my apartment at the time in Brookline, and my friend from grad school, Domingo Cavallo, who was the economics minister in Argentina, and he came back to work after working for Menem. He came back to try and save things in 2000, in the crisis around 2000 in Argentina. And he tried some different things, but it didn't work. But I said to Domingo, if you have a bank run in Argentina, banking crisis, do you insure all the deposits? He said, absolutely. I said, Domingo, do people still run? They know their deposits are insured. He said, absolutely. I said, do they get their money at? He said, no. We close the banks and then we let the money trickle out. And the reason they're running is because they're afraid. They know that the government doesn't have the money, just like the FDIC doesn't have the money. It's going to have to print the money to cover the deposits. We're in a financial crisis. There's going to be inflation one way or the other. And we want to get the money out and buy furniture before prices go up. And so they run, and when they get there, the bank says you can have so much per week, which is what you're talking about here for the US. And then when you get that money out finally through time, the prices are sky high. So your money becomes worth less, if not worthless. So you've been expropriated that way. So you can either lose your money because the bank fails and you're not insured, or you can lose your money leaving it there and having it blocked from access. So all this suggests you want to get your money out in the middle of this podcast, doesn't it?
Yeah,
Right?
well, that's why from my time at the IMF, you quickly learn when you join the IMF that one very important solution to this type of problem is a bank holiday. And a bank holiday means let's now take some days, or maybe even a week or more, and in some cases more weeks, to try to get the banks back in order, to try to figure out their balance sheets and make sure that there is not a too vulnerable and fragile banking sector. But as you say, in many emerging markets, the banking sector is normally a very, very important starting point for a lot of the financial instability situations that we've seen historically.
So we're probably talking about losses in the banking. What would you think they are? $2 trillion?
Well, I don't have a number for that, but I do think that, one very important difference with this banking crisis relative to, call it more normal banking crisis, is that it is very unusual to have a banking crisis in a strong economy. This time around, it is really the most liquid part of the assets on the banking sector that is not doing well, namely because interest rates went up and therefore treasury prices went down. Normally, a banking crisis is because of credit losses on something illiquid, say on subprime loans or on commercial real estate or something that can really be liquidated and crystallized very quickly. So but that's the risk, of course, if we're about to enter a slowdown in the economy, which I think is a bigger risk now, if the banking crisis is going to hold back credit, then of course, the next worry one can have looking ahead is to ask the question, what about the credits, meaning the lending that the banks have given to commercial real estate, to other types of assets that may now run the risk that that could also begin to become a negative consequence for the banking sector. So in some sense, it's still early to quantify any estimates because it all depends so much on what is the economic outlook, if we'll have a deep recession or a mild recession or no recession. But at this point, it's just really unusual that the source of the problem for the banks really is that the Fed has raised interest rates, and some of them were just not prepared for that.
So I think we want to quickly move over to inflation and recession and get into more details there. But you're basically saying that not only have these banks experienced massive losses to the point where over half of the commercial banks are by top finance professors. There was a paper recently by 4 finance professors, one from Stanford and some other schools. They did a careful autopsy of the value of the assets marked to market, and over half again are insolvent. You're saying that even more could become insolvent, or the ones that are insolvent could be more deeply insolvent, because if we have a recession, all kinds of other assets that are not long-term treasuries or similar securities that have been marked to maturity but are marked to market or should be marked to market, they could drop in value. Agreed.
Yeah,
so
one very important part of that discussion is also that if that were to happen, let's say that the US is about to enter recession in the next quarter. Well, in that case, you would probably have long-term interest rates going down. The 10-year interest rates today are, in round numbers, 3.50. Let's say that they go down to 2. Well, that would actually, interestingly enough, solve a lot of the problems on those banks' books that are now experiencing, of course, a significant decline in bond prices, which ultimately would be reversed. That bond prices would go up if interest rates went down, and then the liquid side of the assets would look better. But then, of course, the illiquid side, which again could be commercial real estate for office or other things, could begin to look worse. So there's a lot of moving parts, and they are somewhat counter-moving as a function of whether interest rates remain at these high levels. Let's say the Fed has to keep interest rates high to get inflation down. Well, if that's the case, then quote unquote more pain is needed to get inflation back to 2%. But if inflation is quickly coming back to 2%, then the Fed may no longer need to keep interest rates so elevated. So it is really about what's happening on the liquid side of, meaning the treasuries, both available for sale and held to maturity books, but it's also about what's happening on the illiquid side, which really credit losses, and we really haven't seen anything on the credit loss side at this point.
So even, if you're not going to get paid off on some loan that you've made, a low interest rate isn't going to help raise its value, right?
True.
But are you pushing? Would you be pushing, if you're in the Fed chairman? Would you be engaged in some kind of Operation Twist, trying to raise
I think that
your rates and lower loan rates?
The challenge, of course, is that if the Fed at this point in any way try to ease financial conditions, well, then they don't solve the inflation problem. And inflation today, in round numbers, both on PCE and CPI, is about 5, and the Fed's inflation target is 2. So the Fed has been raising interest rates with the whole idea of trying to lower consumer spending growth, lower hiring, lower capex spending growth, and they haven't really succeeded that much. That's what we have called no landing up until recently. But now it's almost, be careful what you ask for here. Adding a banking crisis on top of an economy that's already slowing down is, of course, running the risk that you can't begin to see the economy slow down. So the next thing that absolutely, from a Fed perspective, needs to happen is that inflation needs to move down quicker, so that the Fed doesn't have to keep interest rates as elevated as they are at the moment. So the macroeconomics of this really depend almost entirely on what is your profile for how quickly is inflation going to come down from 5, where it is today, to the 2% target that Congress has mandated for the Fed.
And I think another important thing if you look at kind of modern macro models, the mathematics of them, the impact of kind of injecting money into the economy you could say we're going to inject less now, but more later. That won't necessarily cool off inflation if people, it's really the time path of the government spending that's going to be financed by money creation that really matters, I think, to the initial level and of the current inflation rate. So it's not like saying we're going to be tight now and looser in the future and try and implement that is actually going to be a credible inflation fighting strategy. Let me ask you, before we again move to these other more specific topics, we saw in 2008, we saw Dodd-Frank, they were supposedly going to fix the financial system. The head of the House Financial Service Commission, Barney Frank, as a services committee, and then we've got probably the head of the finance committee in the Senate, Christopher Dodd. They, quote, fix the system. Dodd goes off to become the head of the motion picture industry. Barney Frank goes off to work to be on the board of Signature Bank, the bank that failed 2 days after SVB for the same reason. So that certainly doesn't smell too good. It smells like this was like a regulation with a wink and a nod. We're going to basically restore banking the way it was, and maybe tighten things up a little bit, and reduce the leverage, allow you to be 90% rather than 95% leverage, but basically, and try and keep more track of you. But obviously they haven't kept track. And now they're going to say, well, if we could just fix this thing. It seems like every 15 years in our nation's history, we've had a banking crisis on average. It's exactly 15 years since 2008, we've got another banking crisis. Do you think it's time for conventional banking to go away? I've been advocating going to mutual fund banking. It's not at all leverage, 100% equity financed mutual fund, intermediation, so that the banks would not be engaged in the intermediaries. Any financial company, including yours, would not be at all leveraged. They would just be taking in money on an equity basis, handing back shares, and then investing whatever they would like, or whatever their investors would like them to invest in. It could be mortgages, small business loans, it could be real estate, private companies. Maybe I don't want to force you to make a pronouncement whether you agree with that, but do you see that the system heading in that direction? I see that happening in real time from this drain from the banking system into money market mutual funds that are holding treasuries and presumably other mutual funds.
There is definitely a move in that direction. If you look at corporates and ask the question in the flow of funds data from the Fed, how big a percentage of financing, meaning of loans to corporates, meaning firms in the US that hire people and do CapEx investment decisions, how big a percentage of their credit comes from the banking sector? In the US, that's about 20%. That means that they also borrow corporates in investment grade bonds, in high yield bonds, in loans. They can borrow from private capital such as Apollo. And given that there is a very diverse financial system in the US, that means that from a pure GDP growth perspective, the more diverse your financial system is, the more resilient it also is. This is in sharp contrast to in Europe. In Europe, it's almost the opposite, that 80% of financing to corporates comes from banks. So that means that we have over time in the US moved more towards a market-based financial system, whereas Europe still has a bank-based financial system. And I think that trend will continue. The disintermediation of the banks playing a smaller and smaller role is indeed a very important development. And that is exactly as you're mentioning, in particular from a resilience perspective, but also from a potential growth perspective. Two dimensions here are very critical. Is not only because you become more resilient in the face of shocks, but it's probably also more growth enhancing if you have a more diverse financial system with many more sources of financing. And I think that trend is likely to continue. And what's unusual about the current situation is, as you're saying, that the bigger institutions that were heavily regulated by Dodd-Frank, as you know, and as you noted, it is the case that there are different levels as a function of how many assets you have as a bank, at 50 billion, 100 billion, and 250 billion. there are different levels of regulation and different levels of things that is required from you. And once you hit that threshold and enter, if you get bigger, let's say you merge with someone and you begin to become into a new level of that type of categorization, that just means that you are going to be doing even more in terms of stress test and regulatory requirements to make sure that the larger institutions do never and are not systemic. And that's why the smaller institutions, which are the ones we're talking about here, they were exempt from a number of these different types of regulation. And that's, of course, a lot of the discussion at the moment, namely, is this going to change or not? So, but the bottom line to what you're saying is that, yes, I completely agree that disintermediation and the role of the banking sector is just getting smaller and smaller relative to other sources of credit in the economy, in particular relative to Europe, that is still, in my personal opinion, relatively far behind, because it's really mainly still bank-based financial system relative to the market-based system we have here.
So my prediction is that 10 years from now, we're not going to have leveraged financial intermediaries. It's just too risky and that every time one of these things happens, the regulators, and there's a big industry of regulators in the government and the private sector, there's also rating companies, and then the banks like to be able to be leveraged because they can take the upside and leave the downside for the taxpayer to cover their losses. I think that that's just becoming untenable, and that we're seeing this movement to limited purpose banking, equity finance. It's really like Islamic banking for the intermediation business, because you'd still have borrowing by households and firms who are not in the business of intermediation, but the intermediaries would have to be 100% equity financed. And then we would never have a banking crisis ever. We would never see a recession called a panic of this year. But let me ask you about inflation. We just had a new report, I guess, about inflation in March. You said it's 5% year to year. From this March to the prior March, it's been a 5%. That's a whole lot better than the 8 or so, 9%, maybe the last time we talked. So inflation's been coming down. What was the monthly inflation rate? And if you compound that over the year, what are the monthly numbers, the latest monthly numbers indicate is the kind of current inflation rate? Nothing.
Yeah, the interesting thing about that great question is that if you look at the 12 months change, exactly as you're saying, it's about 5%. But if you look at the 6 months annualized and the 3 months annualized, it's actually also around 5%. So the challenging thing for the Federal Reserve is that even on a 3 months change or a 6 months change, which you normally would do to try to capture and figure out maybe the economy has been slowing in the last few months and maybe therefore inflation has been going down faster, that is unfortunately not what the data is showing. With 3 months and 6 months annualized change is also close to 5%, and it's not looking like it's coming down very quickly. There's also more complex ways of talking about this. The Atlanta Fed has a so-called core sticky CPI, and the New York Fed has a measure of inflation persistence. These are different ways of both the principal components models, also with simple statistical models, just trying to figure out what is the underlying trend in inflation. And unfortunately, these measures are also not showing strong signs of coming down to 2%. So the conclusion is that at least at this point, at least from the broader perspective, inflation is still just too high, which makes it difficult for the Fed to turn dovish, even in the light of this banking crisis that we're going through at the moment. Because remember, if you're a bank, the funding cost, meaning the cost of borrowing to the person who comes in and would like to buy a car, the cost of borrowing in markets have gone up. And if you're the Fed and you would like to get more loans out to people who like to buy cars and washers and dryers and iPhones, if you want to get that flowing again, well, the best answer to that would be to lower interest rates. But that's just really difficult when you have a conflicting goal, which is that inflation is still too elevated. So a very, very long way of looking at this, going back in history, is that Paul Volcker went through a lot of the same things in 1979 and 81, where we had 2 recessions in the US as a result of the Fed keeping interest rates very elevated. And that caused some fairly substantial economic pain. And maybe that's also what we're looking at here, that the Fed is so intent and keen on getting inflation from 5 down to 2, that it does require more demand destruction. It does require a higher unemployment rate. It does require ultimately really more significant pain in terms of less consumption and less capex spending. And if that's what we have ahead of us, that means that, which I think is the most likely scenario, that we have at least a mild recession over the next several quarters, where the Fed will try to get economic activity down in an attempt to get that number 5 in inflation closer down to that 2% target.
So this is a more pessimistic Torsten than we had a while ago about whether we're going to have a soft landing. The Fed's Volcker, I think, raised the real federal funds rate to 300 basis points. Where's the real federal funds rate today?
Yeah, so you're absolutely right. So in round numbers, the Fed funds rate is 5, and inflation is also 5. So the answer to that question is 0. So in your great models, when you run your computable general equilibrium model and figure out what's happening to real rates, the answer is that real rates are still 0. So you would absolutely be, it's also totally legitimate to ask, well, but if you have 0, that's not even restrictive policy. So that's also why, if you look at simple Taylor rules, other things, they would say that the Fed funds rate should be potentially a good deal higher. If you take Taylor's rule from 93, that would say that the Fed funds rate should be 9. So that's not at all what I think where we're going, but it's very clear that to get restrictive policy, to get the economy to cool down in one of your awesome models would require a real interest rate that really starts to cool the economy down more than what you're seeing when the real interest rates are 0.
So Fisher Black, who I had the great pleasure of knowing before he died so young, and he was a funny, interesting, brilliant guy. He had an argument that the Fed doesn't actually set rates; it just or inflation really it just accommodates that it's the market kind of does this endogenously, and then the Fed responds. And I think in a lot of our macro models, we can't really tell who's kind of driving the car here. And as eccentric, everybody knew that Fisher was highly eccentric. You're talking to him, he's writing notes as you're talking. He would always have a little notebook. So you're quite sure what he's writing, but he took notes in every conversation. But anyway, he had this very strong view that policy was actually just endogenous, not exogenous, whereas we're thinking of it as actually Powell being in charge. But what we're saying is that Powell's not actually doing anything except accommodating at this point. So it's more, to me, that seems fine, but then Powell should be doing some jawboning. He should say, look, I only set one price, which is or maybe a few prices, short, long-term interest rates. I can change the curve, but the term structure, but there's 35 million businesses out there. If you Google the number of businesses, a lot of them are really like one mom and pop stores, but they're setting the prices every day. I need to talk to them and say, here's what we're heading to, 3% inflation. So I don't want anybody to be raising their price above 3% this year, or anybody's wages above 4%. Let's target for 1% real wage growth. And then we're going to go down to 2% and 3% wages, and they're going to have a smooth landing, and you're going to have to help me do this. But the idea, that conversation, Jack Kennedy did that when he took office. The steel companies immediately raised prices like 3%, and he went on national TV and started yelling at them and said they weren't patriotic. 10 minutes later, they lowered their prices. This was immediately called jawboning policy. Do you think that would be useful at this point?
Yeah, so what is very important about that, and that's all your work with our back in terms of, if we think about this from a model perspective, we gotta anchor inflation expectations and just say at 2%, which happens to be their target. The challenge with that is that in some cases that works. You can say, well, my expectations to what inflation will be is 2%. Okay, maybe we can convince people this is a good idea. But in other cases, the markets might be so tight in some parts of the economy, in the labor market, in product markets, in any input market that you could have that you will not be able to anchor inflation expectations at 2%. So that's why if there are imbalances in some markets, for example, in the labor market, well, we can jawbone and say wage inflation should be whatever, 2-3%. But if the labor market is out of balance because 4 million people, according to Brookings, left the labor force because they're now suffering from long COVID, well, that means that there's bargaining power among those workers who have a job because some people have left and are no longer there. And if that's the case, that there's more demand than supply, you could just have that wage expectations are higher than whatever that anchor might be. So jawboning might be helping, and communication from the Fed is certainly very clearly across all FOMC members that they are saying inflation should be 2, it will be 2, and your expectation should be 2. But the risk is that if some markets are out of balance, in particular, some more slower moving markets, not only the labor market, but even commercial real estate, if that takes time to get that cleared, and at the moment you're seeing the price per square foot in office go down by 30%, well, if that needs to stabilize at some point, some markets just move a lot slower, and therefore it might not be able to anchor expectations at around 2%. So all shocks hit the economy, or in the model language, it is really not only about what the prices of interest rates, it's also the unanticipated shock to policy coming from all kinds of things that are moving things around. I think that's ultimately also having a risk to the outcome.
I'm not advocating for price controls that highly inefficient, but I think a little bit more forceful, maybe also from the president, the Treasury Secretary, of trying to set people's nominal view. But then also, how much do you think of this as kind of lagged? You know, if you think about salaries at Boston University, they are set once a year, and even Social Security benefits are set once a year. So we've lost over the course of the year at Boston University, the typical employee has probably lost maybe 8% of their pay in real terms over the last 2 years because of the lag of adjustment. So to get back to the same real compensation, you really, because of these lags, you have to have a higher inflation for a while for it to come back down because of lagged contracting. Is that important in your thinking too, in your modeling?
I do think it is very important, because if you have basically a version of adaptive expectations, or things take time to adjust, you will have essentially business cycle swings as a result of those adjustments taking time. So I do think exactly as you're saying, that the real incomes have been negatively impacted simply because inflation has been higher, meaning in nominal terms, than nominal wages. So now the question, of course, looking ahead, well, if both of them come down at the same time, then there will have been a loss period of several years where basically households and workers simply had wage growth that was not high enough relative to what was happening in consumer prices. So over time, those things don't have to even out, unless, of course, you have direct indexing in contracts, but that's mainly was in the 1970s, and there's some parts of that even in Europe and in Germany today, but broadly speaking, that's no longer the case. So that's why there will be, in plain English, some losses on consumers when inflation has been so elevated and higher than what wage inflation was doing.
So you're seeing, let me just ask you, I don't want to keep you too much longer because I know you have a time constraint here and we've gone about 15 minutes already, but a couple of quick last questions on my part, and then let's, have you say anything you think we've left out here to talk about. But you said that commercial real estate prices you're seeing falling around 30%. That's kind of across the board around the country. That's enormous, right?
That is pretty significant.
This is because people aren't coming back to work.
Exactly. And not only are people working from home and getting more hybrid work models, which is, of course, hurting offices, but we're also seeing that interest rates are still very elevated. So that means that cap rates on what you're getting return on your office investment, the requirement to basically create a return that's higher than a 5% Fed funds rate has just increased tremendously. And not only that, when these deals need to be refinanced over the next several years, there's a maturity wall over the coming years in terms of, okay, if suddenly the equity value, if the value of a skyscraper has gone down, then of course it becomes very important to think about, well, what is then the loan to value once the loan has to be refinanced a few years later. So there's a lot of people that are spending a lot of time thinking about this, of course, particularly pronounced because regional banks account for roughly 70% of all commercial real estate loans outstanding. So for office particular, this is a challenge. There's a very important buffering element here is that commercial real estate is not only office, it's also retail, it's also apartments, it's also hotels, it's cell towers, it's solar panels. So commercial real estate is a very, very broad range of assets, but there are certain categories, in particular office and retail, that are a bit more challenged. So that's why finding the numbers and doing the homework around what exactly is the magnitude of this problem is very, very important. And also asking who are the holders then of these types of CMBS deals, or in this case, which regional banks are more exposed to this problem than others. And there's a lot of people in hedge funds and other places that are spending a lot of time doing that hard work and trying to identify where is it that these losses might be located?
So I wrote a paper, it's on my website, kotlikoff.net, called The Big Con, under articles, which argues that in some objective sense, the subprimes were just too small a deal, and they were actually not that bad in terms of how they turned out, even despite the Great Recession, which wasn't so great. That the whole thing was basically a con. Got overly concerned about this small part of the financial system, but it was enough to bring us into a very big recession. It was basically the second largest in the post-war. Well, pretty much the same as the 81, 82 in terms of 10% unemployment, same as then. Are you thinking possibly that the commercial real estate decline in price could be the new subprimes?
So this is a very important question. I mean, it depends on the ripple effects. The big difference, of course, with the subprime issue was that the resets were the mortgages were designed in such a way that people who took out a mortgage got a very low teaser rate, and after 2 years they were resetting at a higher payment every month that could potentially be as twice or even three times as high. There is not this type of reset where you get such a shock to, at that time, consumers, or today to holders of commercial real estate. So in that sense, I don't think it will be anything nearly as bad as it was in 2008. But it's a very, very critical question you're asking, namely, what are the ripple effects? Who are the holders of these assets that now are not performing well? So it's very similar, as you're saying, and from your paper, it's very similar to the conversation about, well, maybe the loss in this asset, and now it has to be commercial real estate, is going to have a certain magnitude, but it is all about the ripple effects and confidence effects around to what degree people perceive this and get impacts on their balance sheets of this as something that's important or not. And that remains to be seen. At this point, I still think it's a manageable problem, that meaning that this is not going to have dramatic macroeconomic impacts. But it obviously is still a bit early. So that's why the next few quarters will probably have weaker growth. But the Fed obviously knows and understands and is following this problem, I'm sure, quite closely.
So you're ending on an upbeat note, and we have to wonder whether this is just because you're Danish.
No, well, that's good. Maybe the upbeat note here. This is a very important part, and maybe a good way to end our conversation. Let's just back up and ask one thing. Well, how serious is this from a long-term perspective? Well, there's a lot of long-term issues that we spoke about with regulation and other structural things, and what the nature of the banking sector might look like, and financing for corporates and for consumers. But one thing that is very, very important in my view to remember is that this banking crisis will all blow over. This inflation problem will all blow over. And when you and I sit down, maybe even in 6 months, but definitely in 12 months' time, we'll be talking about something completely different. So it's very important for investors. Inflation will not be 5% in 12 months' time. It will be a good deal lower. It may even be all the way back at the Fed's 2% target. So for investors, the whole issue, in my view, is that if you wait with investing until inflation is back at 2%, until you know that we did or did not have a recession, and you say, now I know inflation is 2%, now I know we had a recession, so now I will invest in the S&P 500, or now I invest in private credit or private equity, or whatever it is that you're investing in. Well, by then you will have asset prices a lot higher, because the reason why asset prices are so distressed in some parts of the financial system at the moment is because of this uncertainty. So you are paid to take a risk when there's uncertainty. And I feel very strongly that inflation will not be 5% in 12 months' time. So at least that uncertainty will be eliminated. And I also feel very strongly that the banking sector in 12 months' time will be looking a lot better than it does today. So that shock will also have faded. And that means, therefore, from an investing perspective, if we really keep a cool head, it's about figuring out what are the opportunities, what is the window of opportunity that we're seeing now when we have these shocks that are as intense as they are at the moment.
Well, it's lovely to have some enthusiasm and some cheer at the end of this.
Maybe that's where my Danish part comes from here.
Anyway, you are just a delight to talk to. I feel like I'm learning something every 2 seconds, and I'm going to have you back on as soon as you'll allow me. And thanks so much again. Everyone, please subscribe to larrykotlikoff.substack.com. Get your mother-in-law, your worst enemy, your kids, because we're trying to communicate. Economics has a lot to share, and it's a lot of fun in the end to learn about this stuff and be aware of what's really going on. So thanks again, Torsten.
Oh, thanks so much, Larry.